Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on Schafer Cullen. He is from Schafer Cullen, and we are talking about their newly issued ETF, the Enhanced Equity Income ETF, ticker DIVP. This is a covered call strategy, yet it's quite different than some of the other covered call strategies you might be familiar with. It buys individual dividend-paying stocks and combines that dividend income with the option premium. Additionally, this strategy has been run for well over a decade, and they are bringing it to us in an ETF wrapper. So without further ado, please enjoy this conversation with Mr. Schafer Cullen. Hey, Jeff, welcome to the show.
Hey, Brad. It's great to be here. Thanks for having me on today.
So before we get started, why don't you give everybody a bit about your background and your role over at Schafer Cullen?
Yeah, my background is I've been in the business for 30 plus years. I started out on a mutual fund sales desk for Payne Weber when there was still a Payne Weber in Weehawken, New Jersey, which is now part of UBS. And it was a great career to start out with. It was a great place to get trained. And I've been involved in sales and marketing at asset management firms and broker dealers for the rest of my career. Before joining Schafer Cullen for the last 13 years, I actually worked at Bank of America Merrill Lynch, where I sort of ran product for them in the SMA world, ETFs, mutual funds, insurance and annuities. And then when the B of A and Merrill Lynch kind of came together, I ran some offshore funds for them before joining Schafer Cullen. So always on investments. It's been a great industry and really like being in it.
Yeah. So as you and I were joking before we got on, you're prepared for the any hobbies, things you like to do outside of work question. Sometimes people are get a little taken off guard. So what do you like to do when you're not behind the desk or working or running around?
Yeah, I actually spend a lot. I like exercising. So I like the outdoors and exercising. So my wife and I, we usually kind of work out together, whether it's at the gym or go for walks or for hikes, snowshoeing, what have you. And when I have a little Jeff time, I like to fish. I say fish, golf, and skiing would probably be the three. I love fishing. It's just, I could leave my phone in the car and just kind of go out there and just relax with nature. It's really, really, really nice. So those are kind of the areas that I like to spend time when I have some free time.
All types of fishing, or are you a fly fisherman?
I need to graduate up probably from just the classic lake pond. I grew up in New Jersey, but we had a house in Pennsylvania, so we'd fish off the dock for years. And I love just throwing a kayak in, going out in the middle of the lake and trying to reel in something special. It usually doesn't happen, but I enjoy going anyway.
Yeah, I grew up in rural Pennsylvania. We get in the water and fish all the time. But now living in Pittsburgh, I don't know if I'd want to catch any of the fish in the Mon River over here. Who knows what'll come out of there? But I'd like to get back to it at some point. But anyways, back to business. Can you just talk about Schafer Cullen as a whole? What do you guys do to help clients? I know you have the ETF, which we're going to talk about at length today. But you guys do a lot. You have a great history. So could you just talk about the firm a little bit?
Yeah, Schafer Cullen is actually celebrating its 40th year of being in business. We are we like to call ourselves a boutique asset manager, but the reality is we're a mid-sized firm. We manage $24 billion in assets. We have 67 people who work at the firm, but we have one style of investing, and it's basically this low PE kind of valuation perspective. And pretty much we're known in the industry as a value investor with a focus on dividends. And those are the main strategies that we kind of run for clients. But we've been in business for 40 years. We run mostly separately managed accounts. We have a mutual fund sleeve of portfolios that mirror the separately managed accounts. We have some offshore UCITS. And, we just started to get involved with the ETF by launching an active ETF of a clone strategy that we've run for 13 years in SMA. So That's kind of the history that we have. Firms based in New York, but you have people and local sales and marketing people scattered around the U.S. To meet with advisors.
Well, we're here definitely to talk about the ETF. And so you had recently launched, as you said, off of an existing SMA, the Cullen Enhanced Equity Income ETF, ticker DIVP. Can you just dive right into it, explain kind of what the primary investment strategy is here?
Yeah. On the strategy, it focuses on basically owning between 30 and 40 large cap value dividend paying securities. And then what we simply do is we write covered calls, selective covered calls on between 25 and 40% of those underlying stocks. So the portfolio today has 32 stock holdings in it. They're large to mega cap, diversified companies that almost everyone will know. And then we simply look for volatility in those 32 names in the options market to see what names we can write on to get good options premium from those underlying equities. The options that we're writing are all short term, from 2 weeks to 1 month. They're always out of the money between 2 and say 4%. And that will change depending on the stock that we're going to write on and the volatility. And we just rinse and repeat that each and every month. So since the options are typically 2 weeks to 1 month, we're just rewriting options on a continual basis each and every month. The nice part is by writing on the individual securities, there's always something going on. Like today, there's news and headlines in the Middle East and the energy stocks are up, for example, today. So they'll probably write on, or they may write on some of the energy names if they feel like they can get option premium. But the strategy is run for income. So if you're the combination of dividend income and then options premium, when you add the two together, you get this income level that we're seeking. We've run the strategy for 14 years in a separately managed account. And because we're writing options on the underlying names, the minimum on the separately managed account is a little higher than most advisors are used to. It's a $250,000 minimum per account. So a lot of advisors have come to us. We have $1.8 billion in the strategy right now. So there's $1.8 billion in this 14-year separately managed account strategy. And advisors came and said, look, I want to use this strategy in IRA accounts. I want to use it in smaller accounts. I want to use it as a allocation in my fixed income portfolio for additional income. Can you make an ETF out of it? Because it's easier to implement and I can get it at a lower minimum. So we did. We launched it. We just came upon a year's anniversary this past March right now. And all things are kind of clicking.
No, it's great. So you briefly mentioned some of the other kind of covered called strategies. We've seen a lot of kind of innovation in the ETF industry, whether it be covered call strategies, whether it be buffers, whether it be zero downsides. And this is a little bit of a different flavor than traditional covered call strategies. Am I right?
You are. Most of the covered call strategies that are on the market and have raised a lot of money, they'll buy a certain grouping of stocks, whatever that may be, or they're cloning an index, and then they're writing on an underlying index. So they're either writing options on the S&P 500 or they're writing options on the QQQ or puts on it, whatever they might be doing. But usually it's the options are around the index and not the individual names.
So you mentioned you're targeting, 30 to 40 large cap names people would know. So could you kind of describe what that screening process looks like? Like, is there a certain thing you're absolutely looking for when you're starting to add names to this portfolio?
Yeah, what the portfolio manager, the portfolio management team looks for is they're going to screen by lower valuation. So we typically screen for lower PE stocks than are in the Russell 1000 Value Index at the moment. We're going to look for a dividend yield probably greater than 3%. It's usually it's about 3% or higher. We want a dividend yield, but we also want dividend growth, right? So we don't want to buy just low yielders and high dividend. I'm sorry, low PE ratio stocks and high dividend yielders. You're going to wind up in just like utilities or some energy. What we look for is a combination of the three. We want lower PE stocks compared to their historical norm, Brad. So, for example, we're not going to compare a utility to a technology stock for PE ratios. It's going to be XYZ stocks. Historical PE ratio is 25, and right now it's trading at 18 with this market correction. And the dividend yield is now 3.4% or something like that. That becomes attractive to us. We want to see earnings growth from the company. We want to see expansion. We want to see reasons why their earnings are going to rise. And then we want to see is dividend growth and that particular stock coming from the earnings growth in a company. We don't want them to do fancily fancy financial engineering and borrow debt in order to fuel or fund a dividend payment. We want that combination of the three: low PE, dividend yield, and dividend growth. So once those, and then you want a diversified portfolio, because if you're writing options on only two sectors, right? If your valuation brings you to owning, say, staples, utilities, and energy, then that means I have to write, or the team has to write options only in those three options. Well, there's no in those three sectors. So if there's no volatility, you can't get good options premium. So the portfolio managers build a diversified portfolio. There's holdings in each sector of the S&P 500, and then that gives them more availability to write options on. So it's those combinations of the three. And the underlying stocks, Brad, are picked first. So they're picked from a fundamental perspective that we think those stocks are going to go up in stock price, period. After that, those stocks are handed to the options portfolio manager, who looks at them and is looking for that volatility. So he's going to look at that and say, all right, well, are we willing to lose XYZ stock? Let me use an example of ExxonMobil. Are we willing to lose ExxonMobil? And if we don't think the stock's going to appreciate, we'll write an option on it if we can get a good options premium. If ExxonMobil is going to pay a dividend, we're not going to write on it because we want to collect that dividend. The strategies run for income. So we want to collect that dividend. A lot of times the portfolio managers, because I mentioned we buy the stocks because we think they're going to appreciate first. A lot of times they will write half positions, right? So we'll write on half the stock. So if ExxonMobil, if volatility in the Middle East happens, or there's a good earnings on ExxonMobil, we still have half the positions. And if we get called away, we're only losing half the position on being called away. So they're very thoughtful on how they pick the underlying stocks and then how they do the options overlay.
So a couple of questions out of that. First would be, how often are you kind of running this fundamental screen, adding, removing names? I know the portfolio is active, but is it on, kind of a regular cadence?
Yeah, well, the team's always looking for new names. The reality is the underlying names in the 30 to 40 stocks we own, turnover is about 15%, right? It doesn't change that much. And that is simply because you need that dividend yield. So we it's not like a company decides to start a dividend today and they yield 4%. They start a dividend at 1%. They sort of graduate their way up. So what we find is there's a lot of stocks we have in the pipeline as they're moving up in dividend yield, but sometimes they have lofty valuations. So their valuations are a little higher than we want to pay. So we are patient. So that underlying turnover at those names is probably about 15%. Now, in the strategy, because you're writing options on those names, we are called away. I mean, we're called away probably a third of the time. Many times, and most of the time, we usually buy the same stock back. So if we wrote on Exxon, we got a good options premium, we got half the position called away, we'll likely write on it back, or we'll wait for Exxon maybe if we thought it might trend down a little bit, or if they had really robust earnings and it shot through and it maybe trades back, we'll add back to it. Or otherwise, we might move on and then buy Chevron or buy another energy kind of position. So that turnover, though, that leads to higher turnover in the overall portfolio, the enhanced equity income because of the options. But the underlying names, to your main point, is probably about 15%.
Got it. And then you mentioned kind of ensuring diversity within kind of sector, the sector landscape. So you have, a better diversified portfolio other than just, utilities and some of the normal things we would see in traditional value. So are there any guardrails on kind of maximum sector exposure that, maybe you're capping utilities at 20%? Like, is that a hard and fast rule? I'm just making that number up, but
we do. We have sort of guidelines that exist exactly that. I think it's 20% in any one sector at cost. So, the only sectors that usually would be around that range for us as value investors tend to be financials, healthcare, industrials. I don't think we have any sector right now above 20. Most are, the weightings are somewhere around 17. I think in industrials is probably our highest at this point in time. But no, I think those are the largest kind of weighting sectors on position size. I've seen the portfolio. I don't see us going above 5% in any one position. When I look at the stocks we have in here, most of the weightings are around 3.4, 3.5%. And what happens in these situations is the stock starts to run up. Think about the scenario here. You own, again, I'll use ExxonMobil as the example. I don't have the stock price in front of me, but say the stock kind of runs up. And usually what happens is the stock starts to run up. The PE ratio then moves with it until they have earnings announcement. The yield goes down because the stock's appreciating and they haven't increased their dividend yield. Then usually earnings come out. They announce some kind of dividend increase, right? We want dividend growth. That then pushes up the dividend yield, pushes down the PE ratio. So you sort of have to be patient on these positions and let them play out. These are large mega cap, again, as I mentioned, household names that we think can appreciate and we believe will appreciate in price over time. Because otherwise you're just chasing yield. If you're just chasing yield, you can do that. And there's a lot of ETFs that do that. It's just not what we do.
Yeah. So you're getting two sources of income here. You're getting the covered calls and you're getting, the dividend income here. So how does that combination of dividends as well as covered calls kind of enhance the income potential for investors?
Okay. So again, the way we do it is we get about, I'm going to talk about the separately managed account as a baseline here. We get about 4 to 4.3% on average over the course of the last 14 years in dividend yield. So of the underlying stocks we have, historically, when we look at the separately managed account, it's called between 4 to 4.3% that you're getting from dividend yield. The options premium is then added on top of that. And now, look, you need market volatility to get good options premium. Otherwise, you're just kind of writing options and getting called away. So like what's happening year to date for us is great. This market volatility and the headline news with everything coming out of the administration creates good opportunities for us. But that historical yield has ranged between, say, 3% to 3.5+%. So when I look at the separately managed account and aggregate on each particular year, we have ranged over the last 14 years between 7.2 and 8.3 total yield. Of that that 7.2 to 8.3 yield, about 55% has come from dividends, which are taxed as qualified dividends, right? The lower tax rate, they're QDI. And the other half is coming from options premium income, which is taxed as short-term capital gain or ordinary income, which is different than you'll find in some of the other ETFs that exist than just right in the index. Now, again, we can generate, and so the yield range in the separately managed account, that 7.2 to 8.3, the team could generate 10 on yield if they wanted to. You're just going to write on everything and you're going to wind up getting called away a ton. So you generate income, but you give up total return. So we're trying to give you that combination of both. Get good income for you, participate in the upside where it's there. And then you also have that downside benefit, which is actually showing super well for our portfolio this year. We have the valuation discipline first. That helps on the downside kind of capture. Then on top of that, we have dividend yield. And then on top of that, you have option premium income. So there's a lot of downside help. We don't do buffers. We don't do puts in these strategies. We've looked at it. They're expensive. They work for people. They kind of corral you in certain ranges. And we don't really want to do that. We just want to say that this strategy actually is where advisors have done this for decades. This was a corner office financial advisor strategy that they do, and they still maybe do, where they just own large mega cap stocks and they write options for their clients. It just became onerous to do. So we made it to a packaged product for people.
So you bring up an interesting point there in terms of kind of what is a key performance indicator for you, because you guys are looking at valuations. You want stocks to appreciate, obviously, and you want the yield. So it's got to be some sort of dynamic mix between consistent yielding income, but also, you're not looking at, NAV appreciation as an indicator here. So how do you guys view performance when you're running a strategy like this?
Well, what we want to do is deliver what we basically instruct clients that we want to deliver for the strategy, which is on this strategy, it's focused on income generation. So it's first and foremost, it's trying to generate that 7+% in our separately managed account and higher yield, which we've been able to do for the last 14 years. So that's sort of key. That's what we tell people. That's how they use it in portfolios. We see a lot of financial advisors will use it in IRA accounts. They use it as a way to generate income, but then have the ability to be in equities that can appreciate for you and dividend growth, right? A great way to fight inflation is through dividend growth. If you own just the bond, you're stuck with your principal coming back to you and you generate the income, but you don't really get a chance for any kind of appreciation on that over time. So that is sort of how advisors kind of focus on it. But, in an up market, we will have appreciation beyond the income, right? So if we just focus on generating income, the average return in this portfolio might be, say, 7% would be the logical number here. but we have some years where the portfolio's been up 21%. If the market's up 31%, it depends what's moving the market. So far this year, this is obviously recording in 2025, you have a lot of the NASDAQ market sort of getting hit, but you have dividend payers actually positive this year. And we've been participating in that. So the profile is income generation and the ability for total return from the underlying stocks. Because you have to figure out the math here. If we own 32 stocks and we write on average on 33% of the portfolio, okay? So now technically we're writing on, say, around 9 names. Now I told you we write half positions, etc. But just say we did full writes. You're being written on 9 names and you're only called away 25 to 40% of the time. So I'm really only losing 4 or 5 stocks if they get called away, if they break through strike price. So you still have all those other stocks that have the chance for appreciation.
Yeah. So we talk about, a market environment, which could be pretty good for you, which is, you have a little bit of volatility, mega cap, value names are doing well. You're collecting dividend yield. What sort of market is not ideal? I'm guessing almost little to no volatility and sideways. Would that be no bueno?
That's pretty accurate. I would say actually a fast growing market that we've gone through also poses its challenges, because in a fast growing market, sometimes people just want to own the stock versus buying the option. So you actually need volatility. So a straight up market, while good for total return, which we'll participate in, makes the option writing a little bit more difficult. And a sharp down market, same thing. But you got to remember, investors are always sort of betting one way or the other constantly. And that's why writing 1 month options gives us that flexibility. While you might have a pullback in, again, just to say ExxonMobil, you'll have half the people think it's going to go down. You have half the people think it's going to go up. So you have someone who's usually a buyer for our positions on what we do. A sweet spot, to your point, is sort of now. You have sort of this headline risk. There's volatility. There's a bit of a push toward conservative value investing from the go growth that's been on the NASDAQ and the S&P. And that creates a good blend. And the way I liken it is our firm is a value-oriented investment. So we manage non-covered call option strategies as well. And we're often used as a blend with a growth manager for our financial advisors that have used us for decades. And that's how we're viewing the same thing. While many of the popular ETFs that do covered call writing today, they tend to be S&P 500 oriented or NASDAQ oriented, where we're the value side of the equation. We actually blend super well with them. So if people are using those, great. They work super well. I would have them think about us and look at what's kind of happened with the pullback in the NASDAQ specifically and say, well, maybe I should take a portion of what I own in some of these and allocate it to DIVP as a value play, no different than I do my normal core value style investing, growth and value. So we're the only manager I know about on the value side of the equation that's doing covered call writing. And we're not doing on an index. We're actually doing on those individual names that I mentioned.
Yeah. So who would be ideal for this? If there's an investor out there that is just perfect for this, who would that person be?
It's a great question. I know we're on a podcast here. I'm smiling, but a short answer is anyone who needs income. I mean, at the short answer is, look, if you're looking for income generation, what I find a lot of financial advisors will do is they do a great job of blending all things together. They use loan participation notes. They're using CDs. They're doing individual bonds. They're doing munis. And now they're getting access to some of these other, call them income producing ETFs that can generate good yield for them. But I think they're starting to see that there's actually underlying holdings that could be volatile in there. So for us, I think this works great for anyone who needs income and they are okay with some equity volatility from household large cap value dividend names. Because look, if the market goes down, these stocks are going to go down with it. So it's not like a fixed income. It's more risky than fixed income, but you sort of liken it to junk bonds a little bit. Okay, it's probably riskier than junk bonds because you actually own the equities. But when people are doing allocation to junk bonds, they want more yield. They're taking on equity-like characteristics, and this is sort of in that sort of vein. I see a lot of financial advisors using it for the 3-prong approach too, right? Because right now I told you our underlying dividend yield in the portfolio might be 4.2%. but we don't change those stocks underlying that often. And those companies historically have increased their dividends in our portfolio on average somewhere around 6 to 8%. So that 4.2% yield for you, if you stick with us, starts to increase over time as each of those companies increase the amount of dividends they're paying. And then we're just kind of writing covered calls on it. So it's this decent way for people to have a nice conservative equity income strategy with a focus on income and conservative equity. And that's sort of where it can blend in portfolios for advisors.
Sure. So maybe a little bit of inside baseball here, but you guys, have run very successful long-term track record SMAs. You do UCITS, you do the mutual funds. You've been in the what we call the ETF Thunderdome now for about a year. How's it different? How's it going? How are you thinking about getting this thing into advisors' hands?
Me, I could say, like, I've made a lot of product over my life. I kind of went you through the history of places I've worked. I've made mutual funds, UCITS, SMAs, UMAs. The ETF wrapper is just very good. There's no ways to, I almost can't take the other side of the argument. I mean, it's been written about over and over how an ETF is sort of better than a mutual fund. I'm almost starting to think it's just as good as a separately managed account. I mean, it is really well run. We don't have cash drag. You have creation stocks that are handed to us. We could do custom baskets to remove capital gains. We can run it at low cash. It is very, very effective. Very effective. So that is one of the main reasons we made this particular strategy. We manage about 13 different separately managed accounts. We picked this one specifically because it's easy to implement in an advisor's UMA account or a brokerage account where you just want to own a sleeve of something. Very, very easy to implement across the board versus the paperwork and everything that goes involved with a separately managed account. So I have spent a lot of time figuring out what other strategies we should launch into ETFs, and I have a laundry list. Sort of the issue is it becomes a little chicken and the egg. Most of the major firms, we have $1.8 billion, as I mentioned, in the separately managed account strategy. The ETF version has to reach a certain threshold in assets in order for it to be activated at a lot of the major wirehouse firms. They have these internal mandates. So I know that when we hit these strategies, we've been talking to them. They're very active. They're very interested in activating it for us. So for any financial advisors that have familiarity with our separately managed account, the ETF hopefully will be coming to your platform. But in the meantime, you sort of have to go down that path. So I want to make more ETFs here. I'm sort of waiting to see how this SEC ruling comes out on share classes on a mutual fund. It makes a lot of sense for an active manager to sort of wait to see if just adding a share class of an ETF share class to an existing mutual fund would make it more operationally efficient and easier to work with the wirehouse platforms and the regional BDs and the RIAs that we work with where the funds are already available. So we're definitely making more ETF share classes. We're just going to wait a little bit to see how best to do it and the timing. Because if you make an individual share ETF from scratch, you start from zero, where it might make more sense for us. But that's our plan, is to sort of add ETF share classes. And you can see clear as day, this is sort of the future. I've come from a couple different conferences. You asked me how it's been. I could honestly say I love it. There's a huge group of people who only do ETFs, right? So they might love what we do, but if we don't make it available in the vehicle they like to implement it in, then we're sort of missing out. And I've met not only yourself here from a conference, but I've met tons of people that are just doing ETF only, and it's really an interesting platform. And I've also really come to love how open the ETF community is to one another. I will meet firms who do what we do, exactly what we do, and we will share information. And that doesn't happen a lot in some of the other areas that I work with. And it's been refreshing, and it's sort of a throwback to the 1990s when I first started to work. Very collegiate, very cooperative, and it's been really fun.
Yeah, it's interesting. I've had this conversation actually on the show multiple times. It's a unique community because if you've been in the other parts of the business like we have been, it's a little bit more cutthroat. This seems more, hey, how can I help you? How can you help me? How can we, network, do things together, collaborate? And it's been refreshing. But Jeff, I really appreciate your time. I think this is going to be a well-received product. I know you've got a year under your belt. And before I let you go, though, where can people learn more about the firm? Where can they find information on the ETF?
Yeah, anyone who's interested, they can go to cullenfunds.com. That's Cullen funds with an S.com. There's areas there that you'll have a local wholesaler's name will pop up. You can click on that. My personal email, my work email is jeffcullen@schafer-cullen.com. So people can reach out to me directly. Be happy to talk to them about it. That might be a mistake doing that, Brad.
Yeah,
but
I was going to say, hopefully no bots listen to the show.
We're excited. We're excited about the ETF, and I'm glad to talk to anyone about it. So you can get my contact information through there. But cullenfunds.com or info@cullenfunds.com. Ticker again is DIVP. The reason we called it DIVP is DIV for dividends and P for premium. So we thought it'd be easy to mention once we kind of get that in people's heads. It's DIVP. That's how we refer to it. And happy to talk to anyone who's interested. So appreciate being on your podcast here, Brad, and appreciate the questions you had for me today.
All right, Jeff. Thanks so much. We'll talk soon.